On the equity markets, let's just get a sense here. We're waiting on this Fed decision. We've got the debt deal done. Do you think that the equity markets now are looking for more valleys to come this summer?
And that's a great question. I mean, I think the markets in general, they're too optimistic about the Fed rate cuts, and they're not pessimistic enough about why these rate cuts are taking place. Markets are ignoring the fact that growth is slowing down, really in favor of this whole disinflation optimism. You know, you look at the VIX. The VIX is at its lowest level since August of 2021. A recession is likely. We've been telling our advisors a recession is likely in the second or third quarter of this year, probably the third quarter. You look at the data we saw yesterday, ISM new orders, terrible number, LEI. And then you think about Powell. Powell speaks and talks about Volcker all the time. But if you go back to Volcker, Volcker said, we need recessions to slow inflation. So if you expect all of this, plus earnings need to slide down a little further. We've seen earnings come down about 13% from their June high. The average recession, it takes about 20% decline. So we see all this together. Plus valuations are not really reflective of where interest rates and inflation are. We see a lot of headwinds, and we think the conditions are very ripe for a market correction.
All right, the markets may be hoping for cuts. As I said, the expectation is that there may be a pause. What do you think is going to happen here, Gene? What does the Fed need to do at this point to still try to control inflation, slow the economy without sending us off a cliff?
I think the Fed needs to pray a lot that the disinflation trends are working. We've been very critical of the Fed for the last couple of years, but I think the Fed is finally going to get it right. You're seeing inflation slow down, asking rent, you're seeing commodity prices. They're being helped by disinflation, but I think the Fed finally gets it right. And I think more importantly, the Fed is finally talking the markets to where the Fed expects rates to be. You think of the dot plot, end of the year, they're saying 5 1/8. The markets for the longest time have said the year end would be at 4 to 4.5. Now the implied 2023, end of this year for 2023, is at 5.05. So the markets are finally catching up to the Fed. The Fed is guiding. One thing that worries me, though, is that the Fed continues to say we're very data dependent, but they've already penciled out saying we are going to pause at the June meeting. And let's just hope this JOLTS report, I mean, not JOLTS, the payroll report comes in lower than expected, which we think it will, because again, this will help drive the Fed's decision.
30 seconds left. I would like to hear what your favorite sectors are leading into summer.
Oh, great question. So 3 favorite sectors. Number 1, I think this is probably the most used, most overestimated sector, technology. We like technology still. We've been buyers of technology for the last 12 months. You know, technology protects margins, streamlining businesses. Earnings growth is expected to jump 15% next year after falling 16% this year. And the timing is perfect. Think about this. You've got the pandemic-related semiconductor glut is being worked through, and AI needs semiconductors. Technology is feeling AI fever. Number 2, industrials, agriculture and defense spending, weaker dollar. Number 3, financials. We still like financials. Rate hike cycle is ending. Capital markets are starting to open up a little bit. You're seeing some good, easy comps. Recession will likely prove to be mild. All this together says financials could be an attractive opportunity. Technology, industrials, and financials.